Good afternoon, ladies and gentlemen. Welcome one and all to the inaugural Future Generation Investment Forum. I'd like to acknowledge board and committee members of Future Generation Investment Company, FGX, and Future Generation Global Investment Company, FGG. Also, our fund managers for both companies, shareholders, our charity representatives here, brokers and planners, our pro bono service providers who have come along as well, and all others who are joining us. I'm Louise Walsh, the CEO of the Future Generation Investment Companies, FGX and FGG. I'd like to acknowledge the Gadigal people on whose land we are meeting today. This happens to be, I think, the biggest event that we've done for Future Generation so far. It's still early days. We're coming up to our third year. And we're hoping to fill the venue as the latecomers come in as well. Just so you know, we're actually live streaming this afternoon's forum, thanks to our pro bono service provider, Livewire, and it's also being recorded for later viewing via our brand new website, futuregeninvest.com.au. Please use the hashtag FG Investment Forum. We definitely encourage social media, especially Twitter. So what's in store this afternoon at our inaugural investment forum? Firstly, you're going to see and hear 5-minute presentations from 12 of our best performing fund managers with their best 1 or 2 stock picks or investment ideas. It's a bit like speed dating, but obviously it's not one-on-one. It's strictly 5 minutes each, and the fund managers will receive a warning bell at 4.5 minutes, and obviously another bell at 5 minutes. So it'll be a bit like a case of the old red faces, for those of you that remember, hey, hey, it's Saturday, if any of them go over that 5 minutes. So look out, fund managers. 1 slide per fund manager, and if a fund manager is presenting 2 stock picks, they'll be entitled to 2 slides. Your programs have some space in them for notes on the various stocks that you're going to hear about this afternoon. The slides you will see from the fund managers won't actually be available after today. So if you like, please take a photo of them as they're showing up on the screen. I know I happen to do that at conferences these days when I see something interesting on the screen. There's no Q&A from the audience, I'm afraid. We simply don't have time. But you can certainly contact a particular fund manager, if you like, on the back of this afternoon, via their website, or grab them in one of the breaks or at the end of the forum if you're lucky and they haven't darted away. Session 1 will have 6 fund managers presenting, and we'll then have a quick afternoon tea break at 1:30 or thereabouts, and we'll come back in at 2. It'll be a bit probably crowded out there, so bear with us. Session 2 will run from 2 to 3 p.m, and I've got the hard job of trying to keep us on time for the afternoon, including myself. Founder and director of FGX and FGG, Jeff Wilson, and I will then present an update on the companies at 3:30 until 4 o'clock. So anyone can stay on for this afterwards, even if you're not a shareholder of FGX and FGG, and before that we'll have a short break. The FGX AGM will then commence at 4 p.m. and be immediately followed by the FGG Annual General Meeting at 4:30, and we'll certainly have the day completed by 5. I'd now like to call on the founder and director of FGX and FGG, Jeff Wilson, to say a few words of welcome. Thanks, Jeff.
Look, thanks very much, Louise, and thanks for everyone who's come today. Obviously, your FGX and FGG shareholders or WAM shareholders or guests. Future Generation, both entities, FGX and FGG, were created as a way of the investment community and the finance industry to give back to the to the community we live in and operate in. And to me, they are incredibly good vehicles from an investment perspective. And the only reason that is possible is because the generosity of the fund managers, and you'll see 12 of them here today. and I can't thank them enough for what they've allowed us all to achieve. You know, we've got the two entities combined, you're talking about 700 million of assets. And as you know, fund managers, you know, we like charging our fees, which we would normally get paid to manage that pool of capital. All the fund managers involved in FGG are doing it on a pro bono basis. Not only that, but all the service providers are doing that as well. And probably the two largest service providers is the Share Register Boardroom, you know, I can't thank them enough, and the ASX. You know, to me, they're the only two companies in the world, I'd say, where an exchange doesn't charge them an annual listing fee. So I can't thank everyone involved enough. And how do the products work? Like, they are a win-win-win. To me, they're a big win for the investor because you're getting exposure to the smartest domestic and global fund managers, and you're effectively getting that for free. You're not paying anything. 1% goes to, in FGX, youth mental health, and in FGG's case, children at risk. 1% of the assets a year, that's $7 million a year, goes to charities that work in those two spaces. It's a win for the charities, obviously. It's a win for the investor. And is it a win for the fund manager? I actually think it is, because it gives them an opportunity to give back. And again, I just can't thank the fund managers here today for, you know, being as generous as they have been. And when we call you soon to get some more capacity to manage money for free, yeah, please take our call. Now, why we're here today, when we set up FGX about 3 years ago, I remember Gabriel Radzyminski, who's one of the fund managers and one of the board members of FGX, said, look, why don't we do a forum similar to this? We've also got David Prescott here, who's one of the fund managers from Langan. Probably around the same time, he was saying, look, why don't we do a conference in Australia similar to the Sohn conference in the US? The fantastic thing is, last year, Hearts and Minds / Sohn conference was put together, which David, I know, inputted into, but Gary Weiss and Matthew Grounds from UBS spearheaded. And so these type of days are very valuable for people that are really interested in investing in the market. The difference between this here today, if you're a shareholder of the various entities, you come here for free. If you went to the Sohn conference in the US, which I went to, luckily I got a pro bono seat, it was $5,000 US. And if you went to the conference here in November last year, and I think it's going to be the 17th of November this year, it's $2,750 for your seat. So value your seat. And in terms of the information, obviously, have we done a general disclaimer? Okay. Please don't go and hang the fund managers or even myself if we make a mistake. I'm just going to conclude now, but I wasn't meant to give you one stock, because I know Chris Stott, our Chief Investment Officer at Wilson Asset Management, will give you one stock. But I'll give you one just to put on the ledger, and that's Afterpay. I remember when I was growing up, Mum used to use lay-by a little bit. This is the leader in its field, probably the only one in its field that does lay-by online. And I actually think we could easily, the company, it could be the new REA, it has a lot of the REA type qualities. So that's my pick, Afterpay, and so you can judge me in 12 months' time whether I succeeded or failed. Thanks very much.
Thanks, Jeff. This afternoon, with a bunch of fund managers, it wouldn't be complete without a disclaimer. So we certainly have one, And that's actually on behalf of all of the fund managers, the future generation companies as well. Now I'd like to introduce our first fund manager. And before today, I asked each of our fund managers for a bit of a quirky fact about themselves, because in your programs you'll see we've set out the bios and a photo of each of them, and I thought it would add a bit of a human interest sort of side to each of the fund managers. So Ben Griffiths co-founded the Australian small cap fund manager Eli Griffiths in 2003. So Eli Griffiths is one of our very generous fund managers for FGX. But a couple of quirky things about Ben: he's a life member of the North Bondi Surf Club, and he led the rebuild process for the new award-winning clubhouse. So I'm not sure if many of you have seen it, but hopefully you had. It's a real icon building at our icon beach, Bondi. The other quirky thing about Ben is that his father is a famous entertainer, Harry Griffiths, who in the 50s played young Harry in Mackackie Mansions, a famous 2GB radio series, which apparently every household tuned into in the 1950s. So please welcome Ben.
Thanks, Louise. I cannot promise I'm going to do a Steve Ballmer dance. I haven't done one yet. I might do one if my stocks outperform in the next 12 months. You can hold me to it, Jeff. I'm going to talk about two stocks today in the very limited time I have available. All right. Noni B. From Swansea Belmont to greater than 600 stores Australia-wide, Noni B is a revered women's fashion retailer that's currently going through a metamorphosis. Noni B, Rockmans, W Lane and Be Me are probably a couple of brands that may resonate with some of those in the crowd. Part of the excitement of this story for us lies in the turnaround strategy that's currently underway. Noni B has probably nodded off in recent years. The new CEO, Scott Evans, who's a Brett Blundy lieutenant, has swung into action. I've dubbed him up there as a retail toe cutter. His job is to get in there, straighten Noni B up, cut costs and get that business back on track. Part of that, of course, was acquiring Pretty Girl from a group of investors, principally James Packer. Part of that is a complete overhaul of that business. CODB, cost of doing business. Basically integrate that business with the current Noni B business, squeeze out synergies, deliver topside growth, go to the supply chain, see how smarter they can source product, see how smarter they can move product around from store to store. And the final point, of course, is organic growth, how they can grow the business themselves, new stores, right-sizing existing stores, and doing that new thing that they're not even doing, which is online sales, an important sales medium. And of course, the next question that often comes to mind is Amazon impact. What are Noni B going to do about the Amazon effect, which has got every investor, big or small, quite concerned about right now? The Amazon impact as they arrive here, supposedly they're hitting town around September. We think what differentiates Noni B in that instance is that it's certainly in client service. It's a real touch and feel retailer. It's for the value conscious shopper. They're everywhere, as we know. It's got a big regional presence, so it does attract and support the retail communities. So we think Noni B is a terrific little story and one that is destined to perform in the months ahead. My second stock today is PWR Holdings. Its ASX code is PWH. These guys are a Queensland-based designer and manufacturer of world-leading car systems and radiators. Not that I would expect too many in this room to have heard of the product or seen it in their car. You won't have seen it in your car. It currently applies or is used in Formula One racing cars, NASCARs, V8 supercars. It's used in the World Rally Championships across a number of the vehicles, and increasingly in the OEMs, or the major auto manufacturers. Ford have signed up. We're hoping that more and more OEMs will embrace the technology and go forward. The company's had a challenging last 12 months. Financial year 17 won't have been easy for them. That was certainly the indications at the interim. The profit will be down about 30% this year, and that's basically because they are currently investing in the business for the future, whether it's here or in the United States. And of course also the British pound has been especially weak, and something like 80% of this company's revenues are derived offshore. So if you believe the Australian dollar's going down and you believe that the British pound's going up, That will be a favourable combination for this business's revenue model. So the upside comes from not only the bottoming of the pound, which I think, my opinion is that is happening right now. I see Jack Lowenstein's in the audience here. He may have a counter-prevailing view on that. But they hopefully will win more and more major auto companies, the OEMs as I just described them. With any luck, we should see those contracts drop in the next year or two. We think the US aftermarket, where they're establishing a beachhead, should grow and grow successfully. That's our thinking all the same. And as I mentioned, stabilising in the currency. So they're two stocks that we're particularly keen on as a house. They're two stocks that live in our emerging companies portfolio that we've recently launched. And before I hand over to Louise, because I know I've got a bit of time here and I've gone hard and in the interest of conciseness, I just do want to make reference to one of the constituent charities that resides within FGX is the Australian Indigenous Education Foundation. I caught up with Andrew Penfold the other day and he was telling me about the great work they're doing. It's a charity I was not particularly aware of, and I was thrilled to hear that some 500 scholarships will be awarded in calendar 17. So well done, Andrew, and well done, a great effort to the AIEF. That's it. Thanks, Louise. And I will do the Bulmer dance if my stocks outperform any other fund manager here today. I'd like other managers to also enter the fray.
Thanks, Ben, and we'll hold you to that too. And I know my husband's watching by stream, and he's pretty obsessive about Formula One, so I think he's going to be pretty excited about PWR in particular. So thank you, Ben, for kicking things off this afternoon. Now, second up, we have Shawn Fenton from Tribeca Investment Partners. So Tribeca is a fund manager from FGX. Actually, Shawn's starring in the AFR, the Australian Financial Review, today as a result of a presentation, some stock picks he did yesterday at our shareholder update presentation in Melbourne. So thanks, Shawn, for battling the fog in Melbourne and getting there for us. But a couple of quirky things well, not so quirky really, but Shawn is definitely into wine. He plays basketball and he's a surfer. Shawn is the portfolio manager for the long-only Australian equity fund at Tribeca Investment Partners. Thanks, Shawn.
Thanks, Louise, and good afternoon, everyone. So I think we're in a pretty interesting position now in markets. We've had some pretty long bull markets from the GFC with a bit of a sort of Euro-led interruption, but things are getting pretty mature. Interest rates are very low, and increasingly yields been priced very aggressively, yield and growth. So I thought a good stock pick would be something that fits the contrarian mould. So within that range, Telstra has certainly been a very favoured yield stock across the market and continues to deliver a very good yield, but it has been under the pump in recent times. So there's some pretty clear challenges for Telstra. Most obvious and topical is the impact of the NBN and the rollout of our national broadband network and how that impacts Telstra's earnings, both in terms of its voice earnings, which will disappear, and its fixed broadband earnings, which it'll go from being an operator, owner of infrastructure to a reseller under the NBN model. So that transition will wipe a couple of $2 billion off earnings for Telstra, which is a material impact. The good news for them, though, is they did negotiate a reasonably good payment plan from the government. So the NBN will be paying them circa $12 billion in value for its copper network over time, and Telstra has maintained some ability to service that and generate some revenues. So that's a pretty big challenge for them, but the good news is that there is some money coming in to replace that, and depending on how they use that, hopefully with some stock buybacks, reducing the share count, that will alleviate some of the downward pressure on their EPS and their dividend going forward. But that's not really the end of the pressures for Telstra in recent times. It's been suffering a transition across its voice network for quite a long time as the world's transitioned into a mobile space. And as that's been going on, losses in voice have been offset by some very strong growth in mobiles and broadband. And that really accelerated a couple of years ago where Vodafone had some issues, and They hadn't invested in their network adequately, and Telstra really got a free hit there. They got some very good subs growth, and they were able to charge a pricing premium as well. So that really helped turbocharge Telstra's mobile growth. And as often happens in markets and competitive markets, the competition responded. So Optus and Vodafone both reinvested heavily back into their network, and that has put some pressure back on margins. So in the last year or so, we've seen price competition start to increase again in that mobile space, and that's capped out the growth and put a bit of pressure on Telstra, along with some regulatory decisions there in terms of mobile interconnect payments. So that's another issue that after some very strong growth, mobiles have taken a bit of a step back, and that's really been topped off in recent months with a potential entrant or likely entry of a fourth mobile operator there, as TPG acquired some spectrum in a recent auction. So they paid a very handsome price, $1.2 billion from memory, to enter into that market, and they'll spend a further $600 million rolling out a mobile network to cover roughly 80% of the Australian population. So the market was quite severe in its response to this. The Telstra share price really got beaten up on that perceived threat to what had been a stable market structure. Another entrant overseas when we've seen this, even domestically when we had a fourth mobile operator with Three and Hutchinson and Orange, that there was greater price competition. So we look at that and say, yes, there's a risk of increasing competition there, margins being impacted, but in the long term, they're not anywhere near the scale that's been built up in terms of assets and infrastructure, not just Telstra, but across Optus and Vodafone as well. So we don't see TPG being much of a threat in that premium corporate end. Will impact probably a little bit the cheaper prepaid end. So yes, competition's increasing a little bit, but I always like a contrarian investment where, to an extent, the worst case or something close to the worst case is already reflected in the share price. So you've got a very attractive short-term yield from Telstra, fully franked. Yes, that dividend might come under pressure, might be cut, but the company has options, both in terms of buybacks, restructuring its balance sheet, costs out, and underlying that, telecommunications, as you all know, mobiles and mobile broadband and fixed broadband are areas that are going to continue to grow in the economy. So I think now's a good time to be contrarian and take up Telstra. So I think I've exhausted my 5 minutes, and thank you very much.
Thanks, Shawn, very much for that. A well-known brand, obviously, in Telstra. So next up, our third fund manager presenting is Jack Lowenstein. Jack is representing Morphic Asset Management, which is our first fund manager up this afternoon from FGG, so Global Equities. Jack co-founded Morphic Asset Management in 2012, and he was previously the Deputy Chief Investment Officer at Hunter Hall. Jack recently completed an IPO for a new ethical fund, or LIC, and congratulations on that, Jack. A quirky thing about Jack, well, he was quick to answer in that he is obsessed about volleyball, and you'll see him down at Bondi Beach very regularly playing volleyball, and I believe even Twitter knows about it. So please welcome Jack.
Hi guys, I'm not going to bounce around the stage despite my bouncing reputation, and Louise was very kind. She asked for a picture, and I actually had to send her a picture that was in the Financial Review of me playing volleyball at Bondi at 6 a.m. That one I hope is going to disappear from the Twitter space. Anyway, so thanks very much. I better click on to the right slide. Look at that, it worked. I'm here to talk about probably what I think I'm going to guess is going to be the cheapest stock we're going to talk about in probably the cheapest market we're going to talk about. And here's the bigger surprise. It's a business that operates in what is the world's cheapest capital city property market. I've been going to Japan for, God, it's scary, 35 years. And I still remember when I first went to Japan how expensive everything was. You probably all have that stuck in your memory. Tokyo must be a really expensive city. Well, after many years of economic underperformance and deflation, it's not expensive at all anymore. To put it in context, property prices used to be some of the most expensive in the world. they're now some of the cheapest. So I'm going to talk to you about a company called Haseko, which builds what are called in Japan condominiums. That means apartments. And they mainly build them in central Tokyo. So here's a real surprise. The average price for a two-bedroom apartment in Tokyo now is just a little more than half the average price for a two-bedroom apartment in Sydney. How the world has changed. Now, this stock is trading on a P of, it says 6 there, but actually gone up a bit since we made this slide. It's nearly 7 now. It's really expensive. And I say it's trading at 7. It's got no net debt. It's actually got slight net cash, and it's incredibly profitable. It has about an 11% operating margin, and it gets a return on equity of around 25%. So it's a really profitable business. The reason why it's so cheap is that the Japanese investor is convinced that Tokyo is in the throes of a terrible property bubble. Property prices have gone up about 2% a year for the last 10 years. That has to be a bubble, doesn't it? It's also gone a bit faster than that of late, but as I said, prices are really cheap. And the real evidence how cheap they are is that whereas in Sydney, when you buy an apartment, it's actually cheaper to rent. You can rent as a proportion of the cost of the apartment much more cheaply than you can borrow the money. In Tokyo, it's completely inverted. In Japan, believe it or not, you can borrow a 90% loan to valuation, 9% of the price of the apartment, at about 1% a year. If you buy that apartment and then rent it out, you get a yield of 3 to 4%. So you can see it's completely inverted. It's a very, very cheap property market any way where you look at it. But the Japanese are convinced it's a bubble. We're not. And we're also convinced this company is going to keep on growing at a very steady rate. And the main reason for that is Tokyo, which is where this company, by the way, builds 1/3 of all the apartments in Tokyo. It's an incredible proportion. Tokyo is still growing. Japan itself may not be growing, but Tokyo's population is still growing steadily. It's a great sucking sound for the rest of Japan as people migrate to Tokyo. And also what's happening in Japan is that Japanese people, as they age, are moving away from suburban houses to live more and more close to the centre of the city in apartments. I think it's a trend we'll see in many cities, but it's really quite late to come to Japan compared to many other Asian cities, but it's now happening very steadily. So we see this as a growth company trading on very low multiples with very low downside. And one of the evidence of downside, if you like, is that Haseko has a dividend. Woo-wee, that's great. They pay out 20% of their profits. It's a very cash-generative company, but they pay out 20% of their profits in dividends, and they still have a dividend yield of about 2%, which in a country where interest rates are virtually nothing, if you're going to take your money to the bank, is quite attractive. But the really interesting thing, we think, is that even if they stop growing, they'll still generate a lot of cash, and we believe that over time, the pressure on them to raise the dividend is going to be immense. The other thing I like about Haseko is that it's not really a property developer, so it doesn't take a lot of risk. There's people who just build property, and there's people who develop property. Developers have to buy the land and have all the risk of funding it during the development phase. These guys do a little bit of development, mostly just build, but they still, because they're such strong builders, such a great reputation, they actually get to put their brand on some of the buildings. That's a pretty good combination as far as I can see. You don't have to take the development risk, but you get your brand. Do you know what? I might stop. It's been very nice to be here. It's a real privilege. I must say a big thanks to Jeff for including us in both this list and in when we were a very young funds manager in the Future Generations Global team, and I'm thrilled to be here, really am. And I promise I won't just bow on the stage if I win. I'll come back in my swimmers.
I think we'll definitely have to have the photographer for that one then. Maybe Tony Abbott with you, Jack. I don't know. We'll see if he's free, actually. Thank you very much. Thanks for being on time too. Next up, we have Gabriel Radzyminski. And Gabriel is the founder and managing director of Sandon Capital, an activist investment management firm. Gabriel is very heavily involved with FGX. He's a board member as well as on the investment committee. So we thank him for his involvement on a number of fronts. Gabriel said to me when I asked him about a quirky fact about himself that he thought his job was quirky enough. So thank you, Gabriel. Welcome.
Thanks, Louise. Thank you for the introduction. I felt like the quirkiness was a race to the bottom, so I think I got out of that quite well. We're talking about two stocks today, two companies that operate in one industry, as well as a company that owns a royalty. The two companies, again, the way we see it, you might perceive them as being very different risk profiles. One is a low risk profile company, the other one is a high risk. The first company is called Iluka Resources. Iluka is a major producer of mineral sands, and I'll talk a little bit more about mineral sands later on in the presentation. But first of all, I'd like to focus on what Iluka does with its royalty. So it owns a royalty over production of iron ore in an area of the Pilbara in Western Australia called Mining Area C, which is operated by BHP. You'll see that when I wrote this slide, it was still known as BHP Billiton, obviously no longer the case. They produce about 50 million tonnes of iron ore a year, and Iluka owns a royalty on every tonne produced. We believe that the royalty itself is particularly ill understood in the Australian market, given that there are no easy comparators to royalty streams, whereas elsewhere in the world there are quite a number of royalty companies that trade, and typically trade at reasonably fulsome valuations. We think that the Mining Area C royalty has the potential to double over the next 5 to 10 years. The reasons for that is that BHP have recently confirmed that a project called South Flank, which is within the Mining Area C envelope, has been slated as the preferred replacement to one of their big Pilbara projects called Yandi. We think that that has the potential to double the production from the royalty area, and because a royalty doesn't require capex from the owner of the royalty, we think it basically has the potential to double that value quite simply. Today we value the royalty as it stands at about $1.6 to $1.8 billion, and that's excluding the South Flank potential. And we've been advocating for quite some time with the company and other Iluka shareholders that the company should be considering a spin-off of the royalty sometime over the next 2 to 3 years as a way of, one, freeing up its capital as part of its capital management requirements as it builds its mineral sands industry, but also simply because within the current portfolio of Iluka, we believe it's materially underappreciated and undervalued by the market. Turning to mineral sands, the mineral sands industry is a reasonably dark and convoluted place. It doesn't trade, mineral sands, titanium dioxide don't trade on any recognised exchanges. It's basically just contracted sales. And typically the mineral sands industry works in a boom-bust cycle. We're now coming out of what we believe is reasonably a trough for that industry, where industrial production weakened, supply increased, demand fell, prices followed. Whereas now you can see this chart up here, which is a chart of the zircon price out of a company called Asia Metals, has been steadily increasing. Producers have been pushing through price increases. There's been reports both from upstream and downstream producers in the mineral sands industry, or downstream consumers I should say, that price increases are going through. And so we believe that there's some very strong tailwinds behind Iluka on the mineral sands side of things. The other company that I wanted to talk about today, which is perhaps the more pure exposure to mineral sands, is a company called Mineral Deposits. Mineral Deposits owns a 50% share in a joint venture called Tizer, and Tizer itself owns a mineral sands mine in Senegal in West Africa, as well as a titanium slag furnace in Norway. The first time I saw a picture of the slag furnace, I thought it was a holiday resort because it's basically built on a fjord in Norway. One side of the picture looks wonderful, then you actually see the factory and it doesn't look as appealing. I wouldn't be able to convince my wife to go there. But basically, you can see from the map that it has its own operations in West Africa. That's the GCO thing up here. It buys product elsewhere and then it refines up here in Norway. The company's gone through some teething problems in recent years, hence the opportunity for us to buy the shares quite cheaply. It has commissioned the new mine in Senegal. These are big, large-scale operations that often have teething problems. They never work perfectly on day one. And there was a reline of its slag furnace in Norway, which caused a hiccup in production. Book value of the company is over $272 million US dollars. And at today's prices, to make it in US dollars, the market price today of around 55 cents represents a market capitalisation of around 80 million US dollars. And we believe that it's, on that basis, one of the cheapest exposures to mineral sands anywhere in the world. and the replacement cost of the assets, particularly the slag furnace with new environmental restrictions anywhere in the world, means that the replacement cost is again far superior to book value. Thank you. That was almost skin of the teeth stuff.
Perfecto, Gabriel. I think there's a bit of a sand theme going on here. We've got Jack down at Bondi Beach and the sand mining from Gabriel. I'm just wondering if Gabriel wins here with one or two of those stocks, whether he's going to wear his Speedos along with Jack next year, so stay tuned for that. Next up we have Bill Pidham, and Bill is from Elliston Capital, which is one of our fund managers for FGG. Bill is the investment manager at Elliston Capital, and you'll hear certainly soon from his accent that he's Canadian, so he's mad about ice hockey. He's in the midst of the Stanley Cup playoffs. His team, the Montreal Canadiens, unfortunately though was eliminated in the first round, but I gather he's still watching. So please welcome to the stage Bill. Thank you, Bill.
Thank you, Louise, and thanks for reminding me about the first round knockout. So I think the best way to highlight the opportunity I'm going to present to you today is to spend a bit of time around the context, around the long-term secular growth dynamics underpinning the Zayo Group. I'm sure most of you in this room own one of these. And don't worry, Louise, I have the ringer turned off. I'm not here to talk about the phone specifically. However, I just want to make a point about how this device and other new technologies and services are driving a long-term mega trend. Did you know a 4G phone generated 4 times more traffic than a 3G phone did last year? And the next generation 5G phone is expected to generate 5 times more traffic than the 4G phone. So what we have here is a 20 times growth in traffic over the next 5 years, and this is creating a very strong growth dynamic in terms of the data traffic growth over the next several years, and a 7-fold increase in mobile data traffic. Another name for this traffic is bandwidth. And as you can see in this chart in the top right-hand side, bandwidth consumption is compounding. Cisco estimates bandwidth consumption will compound at over 20% over the next 5 years up to 2020, and basically double in the next 3.5 years. We're streaming more and more content with services such as Spotify, Netflix, while cloud platforms such as Amazon's AWS and Microsoft's Azure are creating new and exciting business models for new and old companies alike. The thing is, these growth forecasts are just based on existing technology. Who knows what the future will bring with artificial intelligence, augmented reality, and machine-to-machine applications. A lot of this growth will be driven by mobile traffic. And as you can see in the chart, Cisco estimates mobile traffic will grow every year by 53% out to 2020. So I think we can accept that demand is going to grow strongly. And I actually think the risk of this growth is to the upside. So now to the opportunity. Fiber is at the core of this megatrend and will remain so for decades. It is the essential infrastructure that is required to make all this happen. And as bandwidth consumption increases, the strategic value increases daily. I think of it like this: just like cars would not go anywhere without roads, Spotify, Netflix, YouTube, AWS, or Azure would not go anywhere without fiber. And as I talked about earlier, the traffic on this fiber road is growing at over 20% every year. So fiber is the backbone that connects mobile phone towers, buildings, data centers, and increasingly homes. So now to the Zayo story and how we are participating in this mega trend. So Zayo is a strategic holding in our portfolio, and over the past several years has been building and acquiring fiber assets across North America and Europe. And this footprint would be extremely difficult to replicate today, both on a cost and time perspective. Zayo's management team have been anticipating this demand driver of fiber for several years, and this has now come to fruition. And we'll see this trend continue over the next several years. So as you can see from the lower picture that just focuses on North America, Zayo owns fiber assets spanning the continent. And while I apologize for how busy this picture is, it just shows how dense and expansive Zayo's assets are. Zayo owns over 10 million fiber miles in North America and Europe, connects over 29,000 buildings in over 370 markets. So while Zayo also owns data centers and provides connectivity services to small and large businesses, the majority of its value lies in its fiber solutions segment, which generates EBITDA margins of around 80%. That's 80%, growing at around 10% annually. As the demand for fibre has been increasing, the strategic importance is being realized in industry consolidation over the past few years. So I just wanted to highlight some of the remaining large players with over $50 million of EBITDA in the US. These include FibreNet, Sunesis, FibreTech, and Lightower. Well, let's pick these off. Over the last 12 to 18 months, FibreNet and Sunesis were bought by Crown Castle, which is a US tower operator, for 17 times and 16 times EBITDA. FibreTech was recently merged with Lightower, and now Lightower is on the market at a similar mid-teens multiple. So what we have now is a setup. Basically now stands as the only pure-play listed fibre owner with national scale in the North American market. We believe this represents amazing standalone equity value to us as shareholders and incredible strategic value to a potential acquirer. We believe Zayo is undervalued today, trading at just over 10 times EBITDA. And remember, those previous multiples were done at mid-teens valuations. This creates an amazing, compelling risk-reward setup for us as shareholders. Zayo's business prospects are underpinned by this incredibly powerful megatrend we just talked about, and also an equally strong management team who are incentivized and focused on generating equity returns for shareholders. So I thank you for your time today. I hope you enjoyed listening to the Zayo story as much as I did presenting it to you. And thank you, Louise and Jeff. I really appreciate you allowing me to present the story today.
Thanks very much, Bill. Very much appreciate that. And it's great to have a stock like that, which, you know, to be perfectly honest, I'd certainly never heard of. And there's some amazing stats there that certainly make you take notice of the potential in that space. So lastly, before we break for some afternoon tea, the sixth fund manager that we'd like to present this afternoon is Graham Hay. And Graham is from Antipodes Partners, who are a fund manager in FGG, Global Equities. Jacob Mitchell founded Antipodes in early 2015, and Jacob was the number 2 man at Platinum before going out on his own and establishing Antipodes. Antipodes has been doing particularly well in a very short space of time and has been certainly one of our best performing managers with FGG. So without further ado, please welcome Graham. Thank you.
Well, thanks, Louise. I fear my story may seem a bit passé, given all the excitement around technology that's been presented so far, but let's see how we go. So the company we're talking about today came into our radar last year as a result of what we describe a market dislocation event. It was a failed merger between the 2 largest office supply companies in the United States, where the competition authorities ruled that the merger would be too significant for the customers to bear. And it's often the case with market dislocation events. You get a separation of price from fundamentals as the parties that are involved in the shares during a merger have to liquidate their positions. And so it was with Office Depot, whose share price or valuation during the merger was touted at around $8 billion, compared to a valuation today, as we speak, of around $2.5 billion. As I mentioned to you, it's one of the 2 largest players in the office supply industry in the US. That market today is already very consolidated, 75% market share held by those top 2 players. And Office Depot should do annual sales this year of around $11 billion on a market cap of $2.5 billion. It has net cash on the balance sheet. So you can see the sort of potential latent value that's represented in this business. But look, why would anyone be interested in office supplies? Surely this is a dying company in a dying industry. And indeed, that is the prevailing consensus view amongst the sell side, where 95% of opinions are either a hold or sell. In fact, there is just one single buy rating on this stock, which in my experience in the US market is very unusual, unless you're on the teetering on the edge of bankruptcy, which is certainly not the case. But look, US retail, as we know, has and continues to be a very tough place to operate. And so it's with some caution you may look at this name. But the truth is, office supply as a business has been tough for a long period of time. And it's not without good reason that the industry is consolidated down to 2 players. And those 2 players have survived and are around today because they have developed very refined e-commerce, logistics and supply chain capabilities. And in essence, I think that is what you are buying today. You are buying the platform that is enabled by those investments. You know, unlike lots of companies in retail who are yet to feel the effects of Amazon or are just dealing with the emergence of Amazon into their business, with 2/3 of sales already online today and over 1,400 distribution points across the country, one might argue that both Office Depot and Staples are already the Amazon of the office supply industry. And in fact, a point to note is the fact that Office Depot price match Amazon on all of their products. So the impact of Amazon is already felt in the sales, the margins, and therefore the multiple that's applied to the shares today. So we think the Amazon effect for office supply is probably overstated. There's a new CEO at the helm. The ructions of the last couple of years meant that the prior CEO took early retirement. A new guy has come to the helm. This guy oversaw Lenovo's US operations as the chief operating officer for the prior decade. If you know anything about Lenovo and the PC industry, you know that there's nothing that's not more cutthroat than selling PCs, particularly when you go in as a foreign competitor into the US market and you take on the likes of Dell and HP on their home turf. Lenovo's achievements in the US and indeed globally over the last decade are extremely strong. And we think this guy's pedigree is very right for the situation at Office Depot. But the platform I mentioned is interesting because what it means if you've developed this type of logistics and e-commerce platform is you can start to think about adjacencies to serve rather than just the core office supplies business. So we think there's lots of opportunity for Office Depot's new management to address new categories. They have a very deep business-to-business capability inside the company. 2/3 of sales go to corporates, and corporates obviously demand a lot more than just office supplies. So things like sanitation, janitorial supplies, kitchen, and the like are new areas they could serve. The CEO's experience in electronics will also be brought to bear. There's a whole bunch of categories that the company could potentially address from that. As well. And I'll just finish up on this one point on valuation. We think the business is capable of doing 80 cents a share in EPS in 2018. It puts it on 6.5 times earnings. As we speak, there are a gaggle of investment bankers walking around Australia pitching to offload Office Max from Wesfarmers. That asset has been pitched at around 12 to 15 times earnings, and that's before Amazon have arrived. So if one of those prospectuses lands on your desk or in your inbox, maybe consider that fact in your thinking. Thanks very much.
Thanks very much, Graham. So there you are. We've had our first 6 fund managers present their stock picks. So we're halfway through, and hopefully you've got some interesting tips there to go away and do your due diligence and whatever else you do following today. So now we'd like to break for some afternoon tea. So if any of you want to corner one or more of those fund managers, please do so. And we'll be back here just short of 2 o'clock, please. Thank you.